Hi everyone, welcome back to the Bull Put Spread Trading Series. I'm Patricia Saylor, Managing Partner of Saylor Financial Fundamentals. I love teaching novice investors, but I've created this series for options traders who want to take things up a notch. This is episode 3 of a 5-part series where I'm setting you up for success with bull put spreads. If you have watched episodes 1 and 2, I've made sure you have the background knowledge to be ready for this strategy, and we've already covered the basics of what a bull put spread is. If you've not watched them yet, I suggest you back up and check them out. The links are in the video playlist. Today, we're building on that foundation by showing you how to actually select, set up, and place an order. At the outset, you have a few decisions to make. Note, if you look online, you can find some trading services that will tell you exactly what strike prices and expiration dates to choose. As you know now, if you've watched any of my educational content, I don't do that. I don't tell you what to trade, but I will help you learn how to make these decisions for yourself so you can select trades that align with your own risk tolerance and portfolio size. To select and place your order, there are a few decisions you'll need to make, but I'll walk you through them. Choose an underlying stock or ETF. Select an expiration date and the strike prices for the two legs of the trade. I'll show you how to use the bid and ask to predict your net credit. Enter the order, document it on your trade log spreadsheet, calculate your annualized return, make a plan for trade management in case things don't go your way. I'll show you more about trade management in the next couple of episodes. I'll be demonstrating on the Schwab ThinkorSwim trading platform and using the same trade log that I use for my own personal trades and my YouTube trading videos. Why is logging your trades important? Well, proper trade setup and record keeping are key to staying organized, tracking your progress, adjusting your trades when necessary, and ultimately becoming a more confident and profitable trader. By the end of this episode, you'll know how to log your trades for accurate planning, monitoring, and analysis. The first step is to choose the right stock or ETF. For a bull put spread, you'll want an underlying asset with a bullish trend or, at the very least, a neutral outlook. I like to use this strategy on a few heavily traded ETFs, but you can also do this with individual stocks. Here are some criteria to consider as you select your underlying position. Look for stocks or ETFs that are in an upward trend or that have strong support levels. Look for something that is heavily traded with at least weekly expiration dates and a lot of closely spaced strike prices available. This makes it easier to adjust your trade if needed. I'm going to use QQQ for this demonstration. Since I traded in my personal accounts and I already have a widely viewed video series showing how I trade cash secured puts and covered calls around it. Your next step is to choose an expiration date and your two strike prices. Select an expiration date that aligns with your trading plan, typically between 2 and 45 days out. Longer terms provide more premium up front, while shorter terms offer smaller premiums but allow for quicker turnover, potentially resulting in more income over time. Short-term trades, however, require closer monitoring and active management. When trading bull put spreads, I often lean towards shorter expiration dates, aiming for smaller, more frequent premiums. This approach can result in higher returns overall, but demands more attention. There's no universal right way to set this up. Experimenting within your strategy will help you find what works best for you. Let's take a look at QQQ as an example. For this demonstration, I know I want an expiration date 2 to 6 days out. It's always a good idea to compare multiple expiration dates while fine-tuning your trade setup. Strike prices will depend on your capital requirements and the net credit that you expect to receive. The bid price represents what buyers are willing to pay, while the ask price shows what sellers want for a specific option. These numbers are key to estimating your net credit when setting up a bull put spread. The difference between the bid price of the short put, the option that you're selling, and the ask price of the long put, the option you're buying, reflect the minimum credit you can realistically expect. While you can set a limit order for slightly above this for better credit, these bid-ask prices give you a solid baseline. Remember, these numbers fluctuate in real time as buyers and sellers negotiate. Let's say the bid price for the short put is 34 cents and the ask price for the long put is 23 cents. The difference, 11 cents per share, is the net credit you can confidently anticipate. You might aim for more, but 11 cents a share is your fallback in a less liquid market. This calculation is essential for comparing strike prices, helping you find the right balance between risk, reward, and probability of profit in your bull-put spread setup. Now, let's discuss selecting the right strike prices for a bull-put spread. My approach is to pick a long put with about a 10% chance of going in the money. Keep the strikes as close together as possible and ensure the premium is meaningful enough to justify tying up my funds. To find a suitable strike price for the short put, I use the probability in the money column on Schwab's ThinkorSwim platform. Probability in the money is simply a translation of delta into a probability format, which I find more intuitive and easier to work with. If you're curious about delta, there are plenty of resources online, but for me, Schwab's probability in the money is a straightforward and helpful tool. I typically trade conservatively, aiming for a short put with about a 10% chance of going in the money. If I'm confident the share price will move up, I might aim for a strike price with a 15 or 20% chance that it would go in the money to capture more premium, but this is less common for me. For the long put, the one I'm buying for protection, I choose a strike price that's not much lower than the short put. The difference between the two strikes determines both my potential maximum loss and the amount of capital that I need to reserve for this trade. Keeping them close minimizes risk. There's another reason to keep the strike prices close when I open a trade. If the trade goes in the money, I may need to roll it out and adjust the spread as part of my trade management. Leaving room for repairs is a key part of my strategy, and I'll cover that more in episode 5. For example, on QQQ, the $521 strike with 2 days to expiration has a 10.23% probability that it will go in the money, while the $519 strike has a 7.19% probability in the money. These could form a solid bull-put spread setup. Now, let's set up the trade. Remember, a bull-put spread involves selling a put option at a higher strike price and buying another put option with a lower strike price. This creates a credit spread. I'll receive a premium up front, and my risk is capped because of the protective put that I purchased. Here's a live demonstration of the order and execution of this trade on the Schwab ThinkorSwim trading platform. Give it a watch, and then we'll go over some details. You might want to return to it for another view after the analysis. Today, QQQ is trading at $529.70 some cents a share, and I'm looking at two possible trades. I look at December 13th expiration date. I can set up a bull put spread by choosing a strike price of $521, which has about a 10% chance of being assigned, and then buying a put with a strike price of $519. So I would bring in about $10 less trading fees for this spread. I also looked at an expiration date 6 days out, and with a very similar trade with a $517 strike price and about a 10% chance of being assigned, I could receive $46 and then buy a protective put with a strike price of $515 for $37. And that again would bring me $9 or $10, but I would need to hold the trade open for 6 days instead of 2. So I'm going to set up this December 13th trade. sell to open with a strike price of 34. I'm sorry, sell to open with a strike price of $521 and a bid of 34, and then buy a protective put with the same expiration day and a strike $2 below. And it just filled. I received $11 less trading fees, so then I come to put it on my spreadsheet. My maximum loss is potentially $200, and I booked a premium of $968. And based on this very brief 2-day holding period, that comes out to an 883% annualized return, which is larger than I usually get. Current share price is $529.73. There are a few things I want to make sure you noticed during the trading sequence. I enter the 2 legs in one order. I know that I'll be charged about 66 cents for each leg of the trade, so when this order fills, I'll subtract $1.32 from my credit total. When I'm trading cash secured puts and covered calls, my premiums are usually larger, and 66 cents, even times 2, is a negligible amount. But if I'm trading for very small premiums, $1.32 a trade can actually make a difference in my annualized rate of return. I always take a moment to review the order details before submitting it. I make sure the net credit matches my expectation and that the trade aligns with my risk tolerance and probability of profit. The difference between the strike prices here is $2, so my maximum risk is $2 a share, or $200, minus the $9.68 credit I receive. My total potential loss is $190.32. The break-even price at expiration is $51,990.32. In the next episode, we'll discuss more about the impact of share prices on profit and loss at expiration. But I wanted you to know there is a number between the strike prices that is important to consider in your decisions. Keeping a detailed record of your trades is crucial for analyzing your performance over time. Here's the information that I recommend logging: the entry date, expiration date, the length of the contract. My spreadsheet is set up to calculate that for me. Strike prices, both the higher short put and the lower long put. The net credit. I don't really see any reason to record the premium for each leg of the trade separately, but you might. Capital requirements for the trade. The annualized return. Again, my spreadsheet is set up to calculate this for me based on the inputs that I've already shown you. And the break-even price, which I sometimes record in the notes. My favorite calculation is the annualized return. By entering the number of days the trade is open, the capital at risk, and the premium I receive, I can calculate an annualized rate of return for my trade. As long as the trade stays out of the money or is rolled for a net credit, this number shows me the return on investment extrapolated to a 1-year return. Knowing the annualized return allows me to compare one trade to another using an apples-to-apples metric. I also like to add in my notes column my plans for the trade if it turns against me. This column is a good place to track and explain any adjustments or decisions to close the trade early. For this trade, I've logged the entry date, which is today's date, the expiration, 2 days from now, the strike prices of $5.21 and $5.19, my net credit of $9.68, and the annualized return based on the capital at risk. It's quick, simple, and incredibly useful for staying on top of your trades. If you want your own spreadsheet, you can build one based on the examples I've created or download one from my website for a nominal fee. My book, The Novice Investor's Guide to Stocks, Funds, and Options, is full of trade examples, though not specifically designed for bull put spreads yet. So far, I'm using the same spreadsheet for cash secured puts, covered calls, and bull put spreads, and it's working well for me. But as I make more of these trades, I may want to break it out and create a sheet specifically for these spreads. You might find it in a future Chapter 7 or a standalone mini book. Stay tuned. You can check out my Amazon author page for my investing book and possible future mini book, and others like Oops, Sorry, and Thanks, a fun little guide to saying thank you and making apologies, co-written with two Japanese fourth graders, one of whom did all the lovely watercolor illustrations. It's written for kids, but adults have found it very helpful as well. You could even use the 5-part thank you structure to write a review of this useful content that I'm creating for you. But back to the spreadsheet. If you want to save time, the spreadsheet with detailed instructions for using it is available for a nominal fee to download from my website, SaylorFinancialFundamentals.com. Over time, you will modify it to meet your own trading goals, but having a template to start with may make that process easier. I'll put a link in the video description in case you'd like to get a jump start. In episode 4, we'll look at the possible outcomes of this trade, but first, let's make sure that you have grasped the important concepts here, and I'll give you a homework assignment. Make sure you know these terms: bull put spread, strike price, expiration date, implied volatility, net credit, probability in the money, maximum risk, break-even price, annualized return. Then, check yourself to make sure you can answer these questions. What are the two legs of a bull put spread and how do they differ? Why is it important to log your trades on a spreadsheet, and what information should you include? What does probability in the money indicate, and how is it used in setting up a trade? How is the maximum risk of a bull put spread calculated? Why might a trader choose an expiration date that is closer rather than farther away? What is the benefit of calculating the annualized return for your trades? Your homework assignment is to build your record-keeping systems before you start trading. Create or download a trade log spreadsheet. Fill in a hypothetical bull put spread trade with the entry date, expiration date, total days in the contract term, strike prices, net credit, break-even price, annualized return, and the share price at the opening and closing of the contract. And that's it. This is probably the meatiest episode in this series, so if you need to rewatch anything, I suggest you go back over it until you feel really confident about the whole process. And remember, there's a study guide, and you can download that from my website with definitions of the terms and answers to the questions.